You want to get smart about Wall Street, like
Yeah.
really understand how the big decisions get made, but maybe without needing that MBA and spending a year buried in textbook.
Exactly. And that's what we do here. This is the deep dive.
Yeah, we wade through all the complex stuff, the articles, the research, our own piles of notes, and we pull out the really crucial insights. Think of this as your shortcut, your fast track to being genuinely informed.
And today, that fast track is taking us right into the pretty fascinating world of security analysis and business valuation. Our listener shared a really great set of sources, and our mission, basically, is to distill it all, find those aha moments, and give you a real feel for how the pros on Wall Street actually size up companies.
Exactly. Forget getting lost in all the financial jargon. We're here to, guide you through the core ideas of security analysis, like who's actually doing this work?
Right.
Where do they get their info? And, crucially, what are the gotchas with that info?
And how they value different kinds of companies, the steady eddies, the high flyers, the ones that go up and down with the economy, even businesses that are really struggling.
Yeah, and we'll touch on some of the big changes happening in the field, too.
So your mission today, if you choose to accept it, is to walk away feeling like you've got a solid foundation. You'll understand how the financial world looks at companies, how they value them. We're cutting through the noise, focusing on what really counts.
Okay, let's dive right in then. What exactly is security analysis at its core?
Well, fundamentally, security analysis is this systematic way of figuring out what an investment, like a stock, is actually worth.
Okay.
Our source material really emphasizes that it's a discipline, right? It's built on this core belief that even though market prices jump around based on, fear and greed, a company has an underlying economic value. And the idea is that the stock price will eventually sort of gravitate towards that value.
So it's not just like throwing darts at a board hoping a stock goes up.
Definitely not. It's about looking past the daily noise and trying to figure out, okay, what's this business genuinely worth?
Right.
But it's also important to remember it's not like physics. It's not an exact science. The term our source uses, quasi-science, is actually pretty good because the business environment is always shifting.
Yeah.
New information, world events. They constantly reshape things.
But despite that, it's still kind of the bedrock for how big investment decisions get made, isn't it?
Oh, absolutely. For the institutional investment community,
Right.
the big mutual funds, pension funds, insurance companies, security analysis is pretty much the main accepted way they justify why they're buying or selling a stock.
Okay.
The basic premise is, sure, human emotions, herd behavior, they move prices in the short term. But rational analysis, looking at the fundamentals, that gives you a better shot at long-term success by spotting when prices get, irrational.
Now, this is where it gets really interesting.
Yeah.
Our source talks about the kind of original playbook, right?
Yeah.
The Graham and Dodd approach.
Yes, indeed. The source mentions Exhibit 1.1, which lays out their very structured method. It involves, first, really studying all the available facts about a company, then organizing that info logically, projecting future numbers based on that, then drawing conclusions about its value based on, established principles, and only then making the investment decision. It's very deliberate, almost investigative.
And in this whole approach, it didn't just appear out of nowhere, did it? It came about during a pretty wild time for the markets.
That's absolutely right. This methodology really grew out of the often chaotic and unregulated markets back in the early 20th century.
Right.
You had rampant insider trading, unscrupulous brokers. It was a bit of a mess. So Graham and Dodd's approach, this scholarly, research-heavy method, was actually quite revolutionary. It stressed doing your homework thoroughly over just speculating. And the key insight that still holds true is that even when the market seems totally crazy, a grounded analytical approach offers a more reliable path.
So who are the people actually doing this analysis, day in, day out?
Well, our source breaks them down into a few main camps. The biggest group, maybe around 65%, they work on what's called the buy side.
Buy side.
Yeah. These are the people managing money for institutions. Think investment teams at mutual funds, hedge funds, pension funds, insurance companies. They're there is actually deciding where to put the money. They're buying the securities.
Okay, got it. They're deploying the capital. What about the other main group, the 20% or so?
That's the sell side. These are analysts working for brokerage firms, investment banks. They produce research reports on companies, on industries.
The reports you sometimes see quoted.
Exactly. They distribute these reports to the buy side, to other clients, And the business model basically is that by providing useful research and ideas, the sell-side analysts firm hopes to get trading business from those clients.
Yeah.
Earn commissions when they buy or sell stocks based on the research.
So there's a bit of an inherent connection there, isn't there, between the research and making money from trades?
Precisely. That link between research and generating trading activity is key to understanding the sell side.
Okay.
Now, beyond those two big groups, the source also mentions other roles. You have sector rotators. They focus more on finding undervalued industries rather than single stocks.
Interesting.
Then market timers, who try to predict, the overall market direction, up or down.
Tough job.
Very tough. And then you've got analysts at smaller, more specialized firms, like maybe a fund focused only on biotech stocks or firms dedicated just to growth stocks or just value stocks. These smaller shops often do really deep, focused research in their niche.
Right, they become real specialists.
Yeah.
So where does all the information these analysts are digging through actually come from? It can't all be whispers and rumors.
Oh, definitely not. There are mandatory disclosure rules. The primary source is usually filings made with the Securities and Exchange Commission, the SEC.
The official stuff.
Exactly. And our source makes a really interesting point about how this has evolved. Before the SEC existed, the documents companies used to attract investors, prospectuses, were often, let's say, heavy on the marketing and lighter on the hard facts.
Ah.
Today, the system is much more focused on comprehensive disclosure. The source gives this example, the Texas Eagle Oil Company. It really highlights how inadequate, even misleading, those early disclosures could be. Makes a strong case for why we need mandated transparency.
So the SEC basically forces companies to, lay their cards on the table.
In a very important way, yes. But analysts don't just use SEC filings. They pull from a whole range of other official sources, too.
Like what?
Company press releases, obviously. Reports from competitors can be revealing. Data from industry associations, government statistics, reports from specialized consulting firms, they all add pieces to the puzzle.
But are there any, blind spots, limitations to these sources?
Oh, for sure. Take business journalism, for example. Our source points out that, newsrooms often have limited resources for really deep dive business reporting.
Right, tight deadlines.
Exactly. And reporters might not have specialized financial training. That can sometimes make them a bit more susceptible to a company's PR spin.
That makes sense. What about those research reports from the sell side we talked about?
Yeah.
Are they always completely objective?
Well, they can be a great starting point. They often give good overviews, initial projections, but yeah, you need to be aware of potential biases.
Like what?
Sell-side analysts can face pressure, right? Pressure to generate those trading commissions for their firm, pressure to maintain good relationships with the companies they cover, especially if their bank also does investment banking business with that company.
Ah, so maybe less likely to slap a sell rating on a big banking client.
It can certainly make it less likely, yes. So the key takeaway is just understanding those inherent dynamics. You need to read sell-side research critically.
Okay, so analysts have this massive job. Sift through tons of info, watch out for biases. How do they actually do it? Is there a standard process?
Well, there are two main ways they generally approach it. One is the top-down approach.
Top-down?
Yeah, you start big picture, look at the overall economy, what's happening globally, nationally. Then, how are the capital markets doing overall? Then you narrow down to specific industries that look promising or challenging, and only then do you look at individual companies within those industries.
So like zooming in.
Exactly. The idea is that these big macro factors heavily influence how any single company will do. Our source mentions Exhibit 5.3, which kind of shows this division of labor. You might have an economist looking at the macro stuff, a market strategist looking at markets, and then the security analyst focusing on the industry and company level.
Okay, that's top-down. What's the alternative?
That's the bottom-up approach.
Oh.
Here, the focus is really on finding individual stocks that seem like good value based on their own specific characteristics, kind of regardless of what the broader market or industry is doing.
So, hunting for bargains.
Pretty much. The source notes that classic value investors, the Graham and Dodd disciples, might screen for companies trading below their book value, for instance, find statistically cheap stocks.
Makes sense.
But even if you're primarily bottom up, you still need some awareness of the bigger picture. You need to understand the macro and industry context to make sure that stock isn't cheap for a really good reason, like being in a dying industry,
Right. You don't want to catch a falling knife, as they say. Let's dig into that industry analysis part a bit more. How do analysts actually get a handle on a whole sector?
One basic thing they do is classify industries. Where is it in its life cycle? Is it a high growth area? Is it more stable, maybe defensive? Is it cyclical, meaning it booms and busts with the economy?
Hmm.
Or is it mature, maybe even declining, or just starting out a pioneer industry? They also look at how different industries tend to react during different phases of the business cycle. The source gives examples like internet retailing as growth, utilities often being defensive, and something like property and casualty insurance being cyclical.
But it can't be as simple as just slapping a label on an industry, can it? Like,
Yeah.
not every company in a mature industry is the same.
Exactly. That's a really crucial point. You can't just paint everyone with the same brush. The source uses Whole Foods as an example. Technically, they're in the mature supermarket industry, right?
Yeah.
But for a long time, they were seen as a growth company because of their focus on organics and health foods. So it really shows you need to look deeper than the broad category.
What other big external things do analysts look at when sizing up an industry?
Oh, technology is massive, huge. Will new tech disrupt everything, create new opportunities? The source contrasts the eyeglass industry, which kind of adapted to challenges like LASIK surgery, with the music CD industry, which
Mm.
got totally hammered by internet downloads.
Right. Big difference.
Government regulation is another big one. Think about Pennsylvania issuing new casino licenses, huge impact. Or Germany creating a tax credit for biodiesel that shapes the market. And obviously, international competition is huge now. Something like 40% of S&P 500 earnings come from outside the US.
Wow, 40%. That's a lot.
It is. So you absolutely have to consider the global landscape.
So it's a really wide lens they need. What about the more specific stuff within an industry, like figuring out demand or how profitable it might be?
Yeah, they do demand analysis. Try to project how much people will want or need the industry's products or services going forward. And supply and demand dynamics are absolutely critical because they drive profitability.
Makes sense.
If supply roughly matches demand, earnings probably follow existing trends. If supply outstrips demand, prices fall, profits get squeezed. The source also briefly mentions Porter's five forces.
Yes, the famous framework.
Right. It's a really useful tool for understanding the competitive intensity within an industry. Rivalry among firms, threat of new entrants, buyer power, supplier power, threat of substitutes. It helps assess how sustainable industry profits might actually be.
Okay, so we've covered the industry view. Now, how do analysts zoom in again from the industry to one specific company? What are they looking for there?
The absolute key focus at the company level is understanding its sustained competitive advantage, often just called SCA.
SCA.
What makes this company special? What allows it to consistently do better than its rivals? Analysts dig into a lot of areas here.
Like what?
Well, starting with just a clear description of the business. What does it actually do? What's its overall strategy? Is it trying to grow organically? Is it buying up other companies? Is it maybe selling off parts of the business? The source mentions IBM selling its PC division. That kind of strategic move can actually make the remaining company easier to classify and analyze.
Interesting. What other parts of the company get scrutinized?
Oh, lots. They look at its products, the markets it serves. How good is its customer support? How efficient are its manufacturing or service operations? What's it doing in R&D, research and development?
Uh-huh.
And critically, the management team. Now, evaluating management is a bit subjective, obviously.
All right, it's not just numbers.
Exactly. But it's vital. You have to assess their track record, their credibility, their ability to actually do what they say they're going to do. And finally, they'll also look at the board of directors. How effective are they? This becomes especially important if the company is speculative or in distress. You need strong oversight then.
Right, a good board can be crucial. So after all this qualitative stuff, strategy, management, industry,
Yep.
then they hit the numbers, right? Financial statement analysis.
Exactly. Now you get into the quantitative side. Financial statement analysis is essential for figuring out a company's past earnings power and trying to estimate its future potential. Analysts use a whole toolkit of financial ratios. Yeah, covering different areas: profitability ratios, how much profit does it make; activity or efficiency ratios, how well does it use its assets; credit ratios, how risky is its debt load; growth ratios, how fast is it growing. Our source uses Neiman Marcus as an example, showing how tracking these ratios over time paints a picture of performance, and how comparing them to industry averages gives you context.
But can you always trust those numbers? I mean, can companies sort of massage the figures a bit, make things look better?
That's a very, very important question. And the answer is, well, you have to be careful. Our source definitely highlights the limitations of accounting data. Management does have some wiggle room, some discretion in certain accounting choices,
Like what?
like how they calculate depreciation on their assets. That choice can directly impact reported profits. And with globalization, you also need to understand the differences between accounting standards like International Financial Reporting Standards, IFRS, versus the U.S. Generally Accepted Accounting Principles, GAAP. Comparing companies using different standards isn't always straightforward.
Okay. And what about, let's say, more deliberate attempts to pretty up the financials?
Yeah, unfortunately, the pressure on management to deliver strong results can sometimes lead to aggressive accounting or even, outright manipulation.
Really? Like how?
Our source mentions some common tactics, trying to inflate sales by, say, shipping products out to customers before a sale is actually finalized. Stability Corporation, MicroStrategy, Vitesse are given as examples where this happened.
Right.
Or maybe manipulating the cost of goods sold by choosing a specific inventory valuation method, like FIFO versus LIFO, or tweaking assumptions used for calculating future pension and healthcare costs that can impact reported labor expenses. Analysts really need to have their antenna up for this stuff.
Sounds like you need a healthy dose of skepticism when reading financial statements. Are there other statements besides the income statement and balance sheet that help analysts get a clearer picture? Maybe one that's harder to manipulate?
Absolutely. The statement of cash flows is incredibly important.
Cash flows.
It shows the actual cash coming in and going out from the company's operations, its investments, and its financing activities. Cash flow is generally considered harder to manipulate than accounting earnings. So it can often confirm or sometimes contradict the picture you get from the income statement and balance sheet.
So follow the cash.
Pretty much. Analysts also need to hunt for things like hidden liabilities or off-balance sheet financing arrangements, which can make a company look less indebted than it really is. And the footnotes. Never skip the footnotes to the financial statements.
Ah, the small print.
Exactly. They contain absolutely crucial details about the company's accounting policies, contingent liabilities, all sorts of things that aren't obvious just from looking at the main statements. Indispensable stuff.
Okay, so they've dissected the financials, read the footnotes. Now, how do they start thinking about the future? Do they categorize companies to help with forecasting?
Yeah, they often use broad classifications. Our source outlines a few common ones. You've got mature companies, usually stable revenues, stable profit margins, predictable mostly. Then growth companies. High revenue growth is the hallmark, but they might actually be burning through cash to achieve that growth.
Right, investing heavily.
Exactly. Then cyclical companies. Their earnings tend to rise and fall with the overall economy. Think heavy equipment manufacturers, maybe automakers. Exhibit 10.6 in the source shows this clearly, comparing GDP growth to the earnings per share of companies like Apollo, Anheuser-Busch, PACCAR.
I see the connection.
And finally, pioneer companies. These are often early stage, maybe pre-revenue or just starting out. They typically have negative cash flow, and a key metric analysts watch is their burn rate.
Burn rate. Why is that so important for pioneers?
Because for these companies that are spending more cash than they're generating, the burn rate, how much cash they're losing each month or quarter, tells you how long they can survive before they run out of money or need to raise more. It's a critical survival metric. You compare their cash pile to their burn rate.
Got it. What about more established companies? How do analysts think about their growth? Is revenue growth the only thing that matters?
Not at all. Even if total revenue is growing, analysts pay very close attention to per-share metrics, especially earnings per share or EPS.
Why per share?
Because a company can grow its total net income, but if it issues a ton of new shares to fund that growth, each existing shareholder's slice of the pie might actually get smaller. The EPS could go down. The source uses the Redwood Corporation example to show exactly this. Revenue up, net income up, but EPS down because of new shares.
Ah, dilution.
Precisely. On the flip side, established companies sometimes use share repurchase programs buying back their own stock specifically to boost their EPS by reducing the number of shares outstanding. The Papa John's example illustrates this.
Okay, so forecasting the future is obviously a huge part of this whole process. What are the main ways analysts try to predict what's going to happen?
There are a few main approaches to forecasting. One is time series forecasting. Basically, you look at the company's past performance, sales trends, margin trends, and kind of extrapolate those into the future. Assuming the past predicts the future, more or less.
Simple enough, but maybe not always realistic.
Right. Then there's causal forecasting. This tries to find links between the company's performance and some external factors, like maybe GDP growth or interest rates or housing starts. This often works better for more stable, predictable industries.
Okay.
And for newer companies or industries changing really fast, analysts might rely more on qualitative forecasting. This involves things like expert opinions, market research surveys, maybe drawing parallels to similar situations in the past, less number crunching, more judgment calls.
Are there any common traps or things analysts need to watch out for when looking at forecasts, especially maybe forecasts coming from the company itself?
Oh, absolutely. A big one to be wary of is the infamous hockey stick projection.
Hockey stick.
Yeah, you know the shape. Flat or modest growth for a while, and then suddenly, whoosh. The forecast shows a sharp, dramatic upturn. Exhibit 11.8 and 11.9 in the source use linens and things as an example. These super optimistic forecasts tend to pop up more often during bull markets or when companies are trying to justify a merger or a leveraged buyout. Analysts need to be really critical of those.
Right. Ask what suddenly changes to make that happen.
Exactly. Question the assumptions behind the surge.
All right, we build up to the big one. After all this analysis, industry, company, financials, forecasts, how do they actually put a number on it? What are the main valuation methodologies?
Our source lays out four main approaches that analysts commonly use. There's discounted cash flow, or DCF, there's relative value, there's acquisition value, and there's leveraged buyout, or LBO, valuation.
Okay, let's start with DCF. Discounted cash flow. You hear that term a lot.
Yeah, it's a fundamental concept. The basic idea of DCF is to estimate a company's intrinsic value, what it's really worth, by projecting all the future free cash flow it's expected to generate.
Free cash flow being.
That's the cash left over for all investors, both debt and equity holders, after the company has paid all its operating expenses and made necessary investments back into the business.
Got it.
So you project that free cash flow out for a number of years, and then you discount those future cash flows back to what they're worth today using a discount rate. That discount rate reflects the riskiness of those future cash flows.
Okay, makes theoretical sense.
A simpler version sometimes used, especially for stable dividend-paying companies, is the discounted cash dividend model. The constant growth version is a well-known formula.
But those future projections, they must be pretty uncertain, right? And that discount rate sounds like it could make a huge difference.
You've absolutely nailed the two biggest sensitivities of DCF. It's highly dependent on your assumptions. Even small tweaks to the assumed long-term growth rate, usually called G or the discount rate K, can swing the final valuation number wildly. The source uses an example, AGC stock, to show just how sensitive it is. And because there's so much judgment involved in picking those inputs, the forecast, the discount rate, or source notes that places like the U.S. Tax Court or the IRS, they tend to be a bit skeptical of DCF valuations. They know it can be manipulated.
Interesting. So if DCF has these potential pitfalls, what about relative value? How does that work? Is it more grounded?
Relative value is probably the most widely used approach on Wall Street, partly because it feels more grounded in current market realities. Instead of trying to calculate some precise theoretical intrinsic value, it looks at how the market is valuing the company right now compared to its peers, similar companies in the same industry.
So comparing apples to apples.
Exactly. Analysts use valuation multiples. The most common are the price-to-earnings ratio, PE, and enterprise value to EBITDA, EBITDA. The basic idea is that similar companies should trade at similar multiples, all else being equal.
Okay, that sounds more practical. Now, going back to DCF for a second, how do analysts even figure out that discount rate, the K? That seems pretty crucial.
Yeah, determining the right discount rate or the required rate of return investors should expect for taking on the risk of earning that stock is key. A very common model they use is the capital asset pricing model, or CAPM.
CAPM. Heard of that one too.
Right.
Tries to quantify the relationship between risk and expected return. But the formula basically starts with the risk-free rate, like the yield on a government bond. Then it adds a market risk premium that's the extra return investors expect for investing in the stock market overall compared to the risk-free assets. And then it multiplies that premium by the company's beta.
Beta.
Beta measures how volatile a specific stock's price is compared to the overall market. A beta of 1 means it moves with the market. Higher than 1, more volatile. Lower than 1, less volatile. Exhibit 14.4 in the source shows examples.
Okay.
But a key point the source makes is that a company's beta isn't fixed forever. It can change if the company's business changes significantly or its debt levels change. So if a company has undergone a major transformation, or if it's not publicly traded, analysts might use the beta of a similar public company as a proxy beta.
What about those really high growth, maybe tech or biotech stocks, the ones that are super exciting but also really risky, maybe not even profitable yet? How do you value those? Does
Yeah.
APM even work? That's a great question. For those highly speculative public companies, our source suggests that the required rate of return, the discount rate you'd use, should probably be much higher, more like the kind of returns venture capitalists expect from private investments.
Because the risk is so high.
Exactly. You might adjust it down a little bit because the public stock is more liquid than a private investment, but you still need to demand a very high potential return to compensate for the substantial risk and uncertainty.
Okay, let's circle back to relative value again. You mentioned comparing multiples like PE and EV/EBITDA. What other kinds of ratios do analysts look at when comparing peer companies?
Oh, it goes way beyond just those two. They'll slice and dice the numbers in many ways. Looking at profitability ratios like, say, operating margin and return on equity, efficiency ratios like how quickly they turn over their assets, credit ratios like debt to equity, growth ratios like sales growth per share.
Wow, lots of comparisons.
Yeah, Exhibit 15.4 in the source actually shows an example database for comparing ratios across companies in the temporary staffing industry. Professionals often use pretty sophisticated software to track and analyze tons of these ratios and how they trend over time.
What about valuing companies that have, like, an uneven track record? Maybe they've been struggling, but there's hope for improvement.
Our source calls these Category 2 companies. They can definitely be investment opportunities if you believe that management has a credible plan to turn things around and improve performance.
Okay.
Now, if a company is actually losing money, traditional valuation methods based on earnings, like PE ratios, obviously don't work very well.
Right. Can't divide by zero or a negative number.
Exactly. So in those cases, analysts might look at other ratios, maybe price to book value, comparing the stock price to the company's accounting net worth. Or, especially if they're thinking about a potential sale or buyout, they might use multiples based on revenue, like enterprise value to sales, or based on EBITDA, even if net income is negative. EV to EBITDA is very common in M&A and LBO analysis.
You've mentioned LBO's leveraged buyouts a few times now. Can you break down how valuation works in that specific scenario?
Sure. The basic idea of an LBO is using debt borrowing money to buy a company. A private equity firm puts in some of its own money, the equity, but finances most of the purchase price with debt, often secured by the target company's own assets and cash flows.
Using other people's money, basically.
Pretty much. So the valuation in an LBO context is all about, can this company generate enough cash flow in the future to pay back all that debt and provide a good return to the private equity firm when they eventually sell it?
So cash flow is king.
Absolutely. Lenders focus heavily on key ratios, like total debt compared to EBITDA, how well the company's earnings before interest and taxes cover its interest payments, even interest, how well its cash flow covers all its debt service payments. The Keene Inc. case study mentioned in the source is looked at as a potential LBO candidate.
What about those really big, sprawling companies? Conglomerates that are in like 5 different businesses. How on earth do you value something like that?
Yeah, for those diversified giants, analysts often use what's called a sum of the parts analysis.
Sum of parts. Makes sense.
Exactly. You break the conglomerate down into its individual business units or divisions. Then you value each part separately using whatever valuation method is most appropriate for that specific business, maybe relative value for one part, DCF for another. Then you just add up the values of all the pieces to get an estimated value for the whole company.
Right.
Our source mentions companies like Motorola, Time Warner, Media General as examples where they've spun off businesses, which often makes this kind of sum of the parts thinking very relevant.
And that third valuation approach you mentioned earlier, acquisition value, how does that fit in?
Acquisition value looks at what the company might be worth to another company that wants to buy it outright, a strategic acquirer.
The takeover price.
Right. And often the price a strategic buyer is willing to pay is higher than the company's standalone market value or its accounting book value. There's usually a control premium paid.
Why a premium?
Because the buyer sees value in getting full control. Maybe they can cut costs, combine operations, gain market share, things called synergies. So companies trading significantly below what they might fetch in a private market sale can become attractive takeover targets.
Okay, so analysts do all this work, top down, bottom up, crunch the numbers, apply these different valuation methods. How does it all come together in an actual investment recommendation? Like a buy, sell, or hold?
Yeah, that recommendation is really the final output, the synthesis of everything. A typical analyst report will summarize the key findings from the top-down analysis. What's the economic outlook? Where are the industry trends? How's this company positioned competitively?
That's the stage.
Exactly. Then they'll present the results from the different valuation approaches they used. Here's what the public company comparables suggest. Here's what recent M&A deals in the sector imply. Maybe here's what an LBO model shows.
Laying out the evidence.
Right. And finally, the analyst has to weigh those different results, factor in any important qualitative judgments about management, about risk, and arrive at a final estimated valuation range for the stock and make that call. Buy, sell, or hold. The Ruddick Corporation example in our source illustrates this whole process quite well.
We've covered a ton of ground on the, let's say, more standard situations, but our source material also gets into some really specialized areas, doesn't it? These special cases.
It does, because not every company fits neatly into the standard boxes. The analysis and valuations sometimes need tweaking. Take private equity, for example.
PE. Lots of hype around that.
There is. But our source points to academic studies suggesting that actually average private equity fund returns haven't consistently beaten the S&P 500, especially after you account for their pretty hefty fees. And analyzing PE is different. Access to information is different, often much more detailed, non-public projections. And the valuation often distinguishes between control investments, like LBOs, where they buy the whole company and usually pay a premium, and non-control investments, like minority stakes, which might be valued at a discount.
Okay, what about natural resource companies? Oil and gas, mining, their value seems tied directly to commodity prices, doesn't it?
It's heavily influenced by them, for sure. Valuing these companies needs a unique approach. It often focuses heavily on the company's reserves, the estimated amount of oil, gas, or minerals they have in the ground that's economically recoverable.
Or assets they actually own.
Right. Analysts value those reserves, add the value of other assets like equipment, subtract liabilities. But there's also this intangible element. How good is management at finding new reserves efficiently and getting the existing stuff out of the ground? Standard financial reports can be less useful here, so analysts rely on industry-specific metrics. Things like the reserve-to-production ratio. How many years of production do their current reserves cover? And finding costs. How much does it cost them to discover a new barrel of oil? The Encore Acquisition Company example shows this. Calculating a potential breakup value, what the pieces might sell for individually, is also common.
And financial stocks, banks, insurance companies, they seem like a whole different beast, too.
They really are. Their main assets aren't factories or equipment. They're basically paper contracts, loans, investments, insurance policies. And they typically operate with much higher financial leverage than industrial companies.
More debt relative to equity.
Exactly. Things like government guarantees, deposit insurance, for example, and just sheer reputation for stability become really important competitive factors, not just price. And the key financial ratios analysts look at are different too. Return on assets, return on equity, liability to equity ratios.
What about banks specifically?
For banks, understanding their credit culture, how disciplined are they in making loans, and looking at their history of loan losses is absolutely vital. For insurance companies, a huge challenge is estimating future losses accurately and making sure they have enough money set aside in reserves to pay future claims. The Progressive example in the source touches on analyzing reserves.
And then there are those really speculative stocks, maybe in cutting-edge tech, where there's a great story, but maybe not much revenue yet.
Yeah, traditional valuation metrics often just don't apply well there. The investment case is often built more on narrative. This company has a potentially revolutionary better mousetrap, or it's backed by famous, successful investors. The Ballard Power Systems case study is an example.
So how do you analyze them?
Analysts might use scenario analysis, what happens in a best case, worst case, base case. They also look closely at valuation benchmarks from private venture capital funding rounds or the pricing of recent IPOs for similar companies as potential, albeit speculative, reference points.
What about companies in trouble? Distressed securities, turnarounds. That sounds like a really complex, high-risk area.
It definitely is. There's a distinction. Distressed securities usually refers to the debt or equity of companies already in serious financial trouble, maybe near or in bankruptcy. Turnaround situations are companies struggling operationally, but maybe not quite on the brink yet.
Okay.
For distressed securities, analysts often screen for situations where there's still a fundamentally sound underlying business, but its securities are trading at huge discounts because of the financial distress. They're looking for value in the wreckage, essentially. Sometimes there are voluntary restructurings where debt holders swap their old debt for new debt or equity.
In turnarounds.
Evaluating turnarounds requires a really deep dive into the quality of the management team. Do they have a credible recovery plan? What are the overall economic conditions? Does the company still have some core strengths to build on? In really dire situations, analysts might do a quick back-of-the-envelope liquidation analysis. What could we get if we just sold off all the assets? The Siegel Corporation example shows this kind of balance sheet focus.
Lastly, international stocks. Investing globally is so common now. Does the analysis change much when you look outside the U.S.?
It can, yeah. People invest internationally for diversification, obviously, but also sometimes because they perceive foreign markets as less efficient, more potential bargains, or because emerging economies might offer faster GDP growth.
Makes sense.
Now, for stocks from developed countries that trade in the U.S. as ADRs, American Depository Receipts, the analysis is often pretty similar to analyzing a U.S. company, though you still need to understand the local market context.
But emerging markets are different.
Yes, emerging markets often come with extra layers of complexity and risk. Markets might be smaller, less liquid. There can be significant political risk, currency risk, and accounting standards and disclosure requirements might be less rigorous or transparent.
So valuation gets trickier.
It can. Applying standard DCF or relative value can be harder. Sometimes factors like, say, a company's connections to the government or its reliance on export revenues become more important parts of the analysis. And figuring out the right discount rate is challenging. Analysts often add a country risk premium on top of a U.S.-based discount rate to account for the extra risks.
Wow. Okay, one last thing our source touches on, asset booms and busts, using the 2008 financial crisis as an example. What's the lesson there for security analysis?
I think the key takeaway from 2008 is just how dangerous it can be when markets get caught up in euphoria and bubbles, and fundamental analysis gets ignored or sidelined. The crisis had multiple causes, obviously the U.S. housing bubble bursting, fueled by complex and poorly understood mortgage securities. But a big contributing factor was the failure of various referees. Yeah, like government regulators who maybe didn't see or act on the risks building up, credit rating agencies that gave high ratings to risky securities, even some analysts and media who perhaps didn't ask tough enough questions. It's a reminder that complacency is cyclical and that rigorous independent analysis is always crucial, especially when things seem too good to be true.
Whew. Okay.
So there you have it. That was a pretty intensive deep dive into the whole world of security analysis and business valuation. We've really covered the core principles, the main methods, and how they get applied in all sorts of different situations.
Yeah, and hopefully you listening now have a much clearer sense of what actually goes into those buy, sell, and hold ratings you hear about.
Yeah.
This should really give you an edge, a framework for understanding a pretty complex but vital part of the financial world. Helps you make sense of the financial news too.
And what's really kind of fascinating, I think, is to start thinking about how these same principles might apply to valuing companies you interact with every day. You know, the brands you buy, the services you use, or maybe understanding the dynamics of an industry you're just curious about.
Absolutely. Thinking about these underlying ideas, competitive advantage, cash flow, valuation, it can really empower you, make you a more discerning consumer of financial information. Maybe even help you spot opportunities or risks that you wouldn't have noticed before.
And, you know, if any particular area really grabbed your interest, maybe DCF valuation or analyzing cyclical stocks or understanding private equity better, we definitely encourage you to maybe revisit the source material or look for more info on that specific topic. There's always more to learn.
Because really the knowledge you've gained from this deep dive,
Yeah.
it gives you a valuable lens,
Yeah.
a way to look at and understand the constantly changing world of finance and business just that little bit better.